Hello, good afternoon. Today on the final bar, we're joined by Jay Petit. Jay's a fellow CMT with Charts Avenue. He's based in Singapore, very kindly joining us at an awkward hour to share his perspective on the markets. The S&P having rallied into yesterday's session, choppy yesterday, choppy again today, finishing in more of a position of weakness. We're in a holding pattern of sorts, and the question is, where do we go from here? It'll be interesting to see which way stocks decide to resolve this congestion zone. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. This is your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to break down the market activity from a technical, behavioral perspective, make sense of the short-term movements of the market, most importantly, connect the short-term of today's trading with a longer-term picture and try to understand how things are evolving day-to-day, week-to-week, month-to-month, and that's how trends really are made. You know, interesting to see a continuation of this theme we've seen in recent weeks, which is a dominance of technology and outperformance of the technology sector with the XLK, flat while the S&P down today. The S&P finishing more in a position of weakness going into the close. That's 2 days in a row. We've sort of weakened in the last hour, and again, we haven't seen that big directional push back lower. We've just seen a holding pattern of sorts, sort of wait and see mode altogether. Now we have some great guests coming up on this show and elsewhere on StockCharts TV to help us make sense of things. I'm excited to hear from Jay later, actually talking about some U.S. stocks on a longer term perspective, which should be pretty helpful right about now for sure. Tomorrow we have Bruce Powers joining us on the show on the 18th. Next week on this show, we have Sam Burns from Mill Street Research on Tuesdays joining us from Boston. We have Chris Brecher from Brecher Trading on the 24th. And then we have Joe Duarte joining us on the 25th. Joe's one of our newest contributors to StockCharts.com, has done such a great job with his blog and also hosting Your Daily Five, which is one of our other shows on StockCharts TV. So excited to have him on the show as well. Also, we sat down with Tony Hansen at a recent money show, and we're going to feature an interview with her on our next episode of Behind the Charts. That's coming up next Monday on June 22nd. If you've missed those, check out the Behind the Charts playlist on our YouTube channel. Some fantastic interviews with some of the best traders, investors, strategists, all with the technical, quantitative, behavioral sort of tilt. It's very interesting to hear their routines and how they got to where they are. Thinking of our market recap today, as I mentioned, the S&P just continues to be in wait and see mode. I think today's trading sort of encapsulated that with moments of brightness, moments of darkness, with at one point, sort of after lunch Eastern time, the S&P breaking to a new high for the day, only to roll over in the afternoon session and close more toward the lows of the day. So the S&P finished lower about 1/3% to 3113 and change. The NASDAQ, though, finishing higher with the NASDAQ 100 up 1/3% to 9982.50 or so. Mid-cap index down 1.3%. The small cap index down over 2%. So this is a little bit of a risk-off move just today. And a lot of that movement came really toward the end. Small caps have been down, or were down for most of the day, but really the biggest move lower came right out of the open and right into close, which is kind of interesting. That's sort of all pointing down to the negative side to see a pullback in small caps right out of the open and right into the close for the day. The VIX a little bit higher today, back just below 34. Looking at some other asset classes, and then we'll look at a chart of the S&P 500. 10-year yields down a little bit today, down to 73 basis points. The TLT moving higher, 0.4% to just around 160.5. Looking at commodities, gold rallied a little bit. A lot of that came in the second half of the day as it finished strong to wrap the day up, just up 0.2%. Commodities as a whole down, with oil down weaker. Energy, the weakest sector by far, down 3 1/3%. If you look at the sector rotation. Let's look at a chart of the S&P, and then we'll get back to some of the other things we can review in terms of sectors and themes. So looking at a daily chart of the S&P, this is why when I say we're in wait and see mode, again, we've come out of this, extreme beaten down level, fourth week in March, rallied significantly. I think this was the most recent pullback here in the beginning of May. We then rallied into the peak that we saw last week or a week and a half ago, topping out around June 8th, just below 32.50. And since then, we are now retesting the 200-day. And as we mentioned in yesterday's show, and I think today sort of continued that, this is either the next corrective move up before another impulse move lower that takes us below support that takes us to further swing lows, or this is the continuation of this rally. This is a pullback to the 200-day, a retest before we continue on to new highs. At this point, I think it's hard to really tell which way we're going to break, and I think you have to wait and see what happens there. There are a lot of ways we can try to make sense of it, and even looking at the next layer down, I feel like it's sort of mixed as well. Today felt more distributive than accumulative, but overall, it wasn't a huge downswing. It was still, pretty mild in terms of a sell-off. 0.5% or less is not a significant move by any stretch, especially compared to the volatility that we've seen recently. It's coming out of an overbought condition, which means at this point, I think we're sort of in the midpoint. But what it does tell me, though, for sure, is that there are opportunities for stock picking, because regardless of what the broad market is doing, there are always stocks breaking down in different configurations. So I think focusing on the groups and stock level could be really meaningful right about here. Looking at sectors, I mentioned on the weaker side, we had energy down 3 1/3%, financials after that, and real estate. And financials and energy were two sectors that certainly a couple weeks ago were sort of the emerging leadership, sort of jumping up pretty quickly. We talked on Monday's show about 3 key stocks to pay attention to. Morgan Stanley was one of those, as a name that was, it's all about the 200-day moving average, and pulling back from that is able to hold support, or does it break down to new swing lows? And today, certainly getting some downside follow through from the financial sector, down 1.5%. On the upside, you have communication services and tech up just a little bit, sort of a rounding error above zero. So really everything was sort of weaker today, to be honest. But the top or performing sectors today, or the least down sectors, were communication services, tech, healthcare, and then consumer is sort of flat right in the middle there, outperforming just a bit. In terms of group and ETF themes, interesting to see Brazil back at the top of the list, up 1.5%, excuse me, followed by some of the Asian markets that were up pretty good. Switzerland was number 2, but you also had Hong Kong, the China A shares, South Korea, Taiwan, all up 1% plus. So certainly a rotation back into some of those markets. On the downside, you have Russia, which is obviously very tied to energy prices, followed by Canada, also with a decent exposure to sort of the basic materials, energy sort of space. In terms of group themes, you had the toy group within consumer discretionary up again, and again, what I'm always looking for is things that look different. And I think if you look at this industry group, it looks different than the overall market, where the market is sort of in wait and see mode. This toys group is not in wait and see mode. It certainly looks more like in long and strong mode. This is a group that's continued to make new swing highs as the market's flustered, sort of stabilizing. This just continues to rally. The RSI not overextended, but in sort of a healthy bullish range. The relative strength starting to turn higher, making a little higher swing low just recently. So it's actually an interesting group to pay attention to, up 2.5% today, which is pretty decent. You also had some other consumer discretionary groups represented as well. Home improvement retail comes to mind. So this would be something like Lowe's and Home Depot, I would want to say, are in that group. So this is a group that's sort of testing previous highs right at that key decision point to see whether it'll be able to muscle through that and move to new swing highs. You also have the semiconductors group, and we'll look at the SMH as a good proxy for that. Semiconductors, as we've talked about, a great leading indicator for the overall market. When semiconductors are doing well, the market as a whole tends to be doing well. This is just this beautiful round trip from the peak in February, the low in March, back up to that same level, just below 153 was the peak in February. We broke just above that about a week and a half ago, and now have pulled back again. And now we're building momentum to see if we can break to new swing highs. But while all that is happening, look at the relative strength, which is broken to a pretty solid new relative high. So again, a group like semiconductors making new relative highs, testing new price highs. if that would break out, it would hard to be that negative on the market as a whole, just because semiconductors are doing so well. And in general, that's tended to be a good leading indicator of the overall market environment. What concerns me now is you have this challenge with tech being an outlier holding up in price while other groups are rolling over. And traditionally, a lot of times you look at when the index does one thing and when something like semiconductors or technology does something differently. And it could be one of those situations where other stocks, things like financials and others, start to roll over, start to distribute a little bit. And then things like technology are the last things, because those are the safe havens people are going to rotate to. And the chart with the relative strength certainly speaks to the rotation into semiconductors right now. On the downside, it's sort of a mixed bag, but a lot of energy groups, a lot of REITs down here in the bottom 10 list. So things like REITs related to hotels and lodging, renewable energy, also E&P stocks, some of the big oil companies, integrated oils, that's Exxon and Chevron and things like that, all down pretty significantly. But also within consumer, you have recreational services and clothing and accessories. So consumer discretionary is a pretty diverse sector. And this is one of those situations where you see some in the top 10 of industry groups and some sectors as well in the bottom 10. So it's sort of a mixed bag for sure. I want to finish up our market recap, but just by pointing out one quick measure of breadth. As we talked about, breadth measures are pretty helpful. And again, one of the charts I'm keeping my eye on is this chart looking at the percent of stocks above their 200-day, percent of stocks above their 50 days, back to 90% of stocks above their 50-day moving average. This is not updated yet for today's trading. This is through yesterday's close. But less than 50% above their 200-day. That's a key level that I'll be looking for to see if we can get back above that 50% line. In general, broader bull market phases with more constructive patterns and upside trends, you tend to want to see this indicator above 50%. That's what all the previous bull phases in the last 10 years have seen. We've not quite seen that yet. It hinted at it, but then came right back down and back below the 50% level. So in terms of breadth, that's one thing that has not triggered yet. I don't think it will trigger today based on the distribution we've seen, but that's certainly where I'd be looking at next. We're going to take a quick commercial break, be back with my guest, Jay Petit from Charts Avenue. We'll see you in a minute. Hello, everyone. Welcome back to the show. This is Dave Keller here at StockCharts.com. Thanks for joining us for the final bar every weekday after the close as we make sense of the markets. We had a great mailbag segment yesterday answering many viewer questions. I'd encourage you to send your questions our way as we deal with this market as it evolves, as you're using stock charts and trying to understand market dynamics. Shoot us any questions that you have along the way, and we'd love to answer them on the air. Two ways to get a hold of us. Just shoot us an email, thefinalbar@stockcharts.com, or tag us on any Twitter comment @FinalBarSCTV, and we'd love to answer your questions in our next mailbag segment later this week. Want to welcome on my guest, Jay Petit, who I've anglicized his name, and I apologize for that, Jay Petit. Another way to maybe the more correct pronunciation, joining us from Charts Avenue in Singapore. Jay, welcome to the show. It's such a pleasure to have you on.
Thanks for having me, Dave.
So you sent two charts ahead of time, and it was great. Some long-term charts looking at two U.S. names that I think have hit your radar. The first in the technology sector, which we were talking about in our market recap. What are you seeing with Ciena?
Well, first of all, I want to define why this orange area is so important, because we are looking at a 2-decade-long basing pattern. So starting from the left-hand side of the chart, we see that in 1998 and 99, the price found some support around the $45 to $50 area. Now in early 2002, after the dot-com bubble burst, the price found again some support around that area before breaking down. In late 2002, early 2003, this area started to act as resistance. And the same goes for 2004 and 2007. Now, after the 2009 low, the price had a bit of a sideways range until the mid-2018, when a mini price breakout happened. At the same time, the RSI broke out of its resistance trend line and went into overbought territories. And when the RSI goes into overbought territories, this is a good sign, right? Especially when the price itself is not overextended. And in 2019, the price retested that 45 to 50 resistance area and got rejected yet again. And only last month was the price able to break out. So now I think as long as the price stays above that 45 to 50 area on a monthly closing basis, I think we can go to 77, which is the 1.618 Fibonacci extension level from the 2007 to 2009 decline. Now, if you want to look at the measured move, that is from the bottom of the basing pattern to the resistance area, and add that to the breakout area, we get a $94 price target. So I think this gives you quite a good risk-reward ratio.
It's a great chart, and I love the time frame of this. Bill Doan, who was one of my predecessors at Fidelity when I ran the technical team, he loved looking at big base breakouts like this, which was just a huge base, and you see when it's breaking to new highs, this is not just a short-term high it's breaking out. This is a multi-year, if not multi-decade peak that it's going above. It's a decent breakout there. Now, chart number 2, rotating groups a little bit. There's a Staples name, Coca-Cola KO. Tell us about this one.
All right, so we start from the 2009 low, and we see that the price has been making higher highs and higher lows, and then started trading within an upward channel. If we now look from 2015, we see that each time the price made a pullback, it found support on the lower uptrend line of the channel. At the same time, the RSI always came down to the 45 to 50 area before bouncing back up. And just a few months ago, in February, we saw a bearish engulfing pattern. So the body of the candle in February engulfed January, which is a bearish signal, especially when it happens on the top of the channel. Now, if you were to take the high and low of that February candle, it not only engulfed January, but it actually engulfed the past 6 months, which is quite significant. And even though the February low only tested the August and November lows and did not take them out. Now in March, the price goes testing the upward trend line of the channel, then reverse and break the August, November, and February support level around the 5150, and then completely break down. And most importantly, closing the month below the channel for the first time in more than 9 years. And likewise, the RSI broke below its own support area. So in April and May, and currently June, each time the price penetrated, penetrated back into the uptrend channel, it got rejected. So even though April and May were positive months, both months still closed below the uptrend line, confirming this old support as new resistance. Same goes for the RSI. It came back up to confirm the 4550 area as resistance, and now looks like it's turning back down. So the price action as well as the RSI are suggesting that there's more distribution ahead.
This is such a great long-term chart, Jay, and you're making me feel guilty for not looking at more monthly charts, because there's a beauty to this, just this long-term perspective and understanding that the market has a rhythm on this time frame. Just a quick question. We only have about 30 seconds left, but I'd love to think with something like Coca-Cola with this chart. I think a lot of people struggle with looking at a longer-term chart like this only because it feels like it's looking at such a large amount of time, and it could take plenty of time for a trend to evolve. What would you do if this, for example, is leaning more bearish, is leaning more negative, but then on something like the daily chart, it starts to look more positive? How do you think about those different timeframes? How do you make sense of them in your work?
Well, I would use, again, you need to know your own time frame, right? But if you're on monthly time frame and it's going down, where the shorter term goes up, then it's a good opportunity to either get out or start a short position.
That's a great way to put it. And thinking of the short term, more the tactical time frame with more of the long term perspective, right? Jay, this was such a pleasure to have you on. I know this is early morning for you, and I can't thank you enough for sharing some examples with us and talking a little bit about your process. Wish you the very best. Stay safe in Singapore, and look forward to hearing from you again soon. All right.
Thanks, Dave. Take care.
That was Jay Petit joining us from Singapore. And again, what I love about Jay's work, it's a long-term perspective here. These two charts that he showed us, showing just some basic rotations. Again, I think a lot of times one of the things we hopefully try to do with the show is try to get away from the short-term flickering ticks. It's so easy in this sort of volatile market to get caught up in the quick movements and the quick themes. And I think what Jay's charts reminded me was to remember that the long term, there's plenty of signal to be received from weekly and even monthly charts, understanding how these trends are evolving and how bases are evolving over those timeframes. Great to have Jay on the show. Our next segment is a new one, actually, called The Mindful Investor. We asked you a poll recently on StockCharts TV and on our YouTube channel about market-related information and how you consume it. Let's look at the poll, and then I'll share with you just some suggestions on how to have a more mindful way of approaching your daily, your weekly routines. The question was, what is the first market-related information that you consume on the average day? And the responses that we gave you were financial TV, newspaper, either paper or online, email newsletters or commentary, a chart, or other. And here's where we netted out. 33% of you, about a third of you, said you start with financial television. 10% of you said a newspaper, either physical or online. I'd be very curious how many are actually still using a physical paper. I'm actually one of those, but I think we're a dying breed for sure. 12% said email newsletters or commentary. 38% said a chart. 8% again said other. So here's the thing, what is the, let me tell you why this is important, and then I'll tell you what, I don't know if the right answer, but the answers I would start to point you to. One of the challenges I've run into working with institutional investors, with financial advisors, and more now individual investors, and helping them improve their process, improve their routines, improve the way that they address the markets and develop an investment thesis. Question number one is, what is your time frame, right? How are you trying to win? And I would say on average, probably most people watching the show are sort of in that medium long-term sort of time frame, meaning you're trying to shoot down the road, a couple of weeks, couple months, and if not much more. So what happens with when we look at market information? You need to think about how you structure your time in a certain order. And if you look at how and I know I'm guilty of using an insane amount of Chrome tabs when I use StockCharts.com, and I've argued in some ways with our founder, Chip Anderson, because he's not a fan of how many charts I load up when I do it this way. But for me, it's just how my brain works. I am such a creature of habit, and I like having a series of things that I start with, and I start on the left and I go through the right. I even have a group of tabs called my StockCharts Weekly Review, and this is what I do every Friday as I'm preparing for the show, is go through my weekly routine, which is a similar pattern to this. So every morning, this is the process that I'm going to use to go through the charts, and the very first chart I look at is a weekly chart, a long-term chart looking at the last 10 years of market history. Now, you may ask, why am I looking at that same chart every day? And my answer is, I'm trying to focus on the long term. I'm trying to have a proper long-term perspective. I'm trying to understand how trends are evolving over that longer term time frame. So if that's the case, the best thing I can do to start my day off with the right mindset and the right time frame in mind is to start looking at long-term trends. If I'm trying to understand long-term trends, that's where I should start. Then once I'm done looking at the long-term trend and defining where I see things, I'll look at something like a daily chart to understand how that fits into the long term. And then I go through a series of processes looking at, and I'm jumping around these tabs here very quickly, going through, long-term market indexes, looking at indexes other than the S&P to see how they relate. So here recently, I'm focusing a lot on the NASDAQ versus the S&P, how they go in. I'll then go through non-US markets over a longer term time frame, looking at other asset classes like commodities, currencies, and so forth. And then I continue on through this process, looking at breadth, looking at sentiment, looking at sectors, then digging into individual stocks. And after I've done all of that, the very last thing I'm going to look at is the movement of the market right now, as well as a portfolio, looking at a current portfolio, a watch list, or something like that. Now, why is that so important? Well, the key to that process, I mean, each one of those has a particular point for me, but the reason why I'm bringing up now as part of a discussion on mindful investing is you want to be intentional with how you're focusing your time, and you want to start things out a certain way. So those of you that are longer term investors, if you answered newspaper or financial television, I would say you're most likely hurting yourself by starting with that, because any sort of financial media tends to be driven by short-term headlines, right? What's happening right now, what's moving right now, what's up the most, what's down the most today, and you will immediately find yourself being sucked into today's activity, right? So even if the long-term trend is positive, if today is a bit of a sell-off, if you start looking at financial media and seeing that as the story, that's how you've primed yourself. And then everything else you look at after that is going to come from that starting point where you're sort of leaning more toward the negative side, because that's the feeling that you're getting today. I didn't ask you like your current portfolio, but that's also a no-no, I would say, because what you do not want to do is look at your current portfolio first, or your clients' portfolios first, and then make some judgments based on what you're seeing right now. You want to start looking at the trends, looking at the big picture movements, make an assessment of where you see things are headed, then look at your positioning and compare what you see happening versus how you're positioned. And if those are in agreement, then that's good. If there's a disagreement, then that's where you want to start to make some comparisons. So those of you that answered things like email, newsletters, or commentary, assuming they have a little more of a longer term feel to them, I'm totally happy with that answer. Those of you that answered a chart, you get a big thumbs up from Team Final Bar, assuming that it's a longer term chart. And then again, that's a big assumption. But my way of wrapping up this little segment, the Mindful Investor, is to encourage you to think about, be intentional about the very first thing you look at during the day. And if you catch yourself looking at financial media, newspapers, anything that's more short-term oriented, I think you're hurting yourself as a long-term investor, because you're getting away, you're disconnecting from the time frame that you're really trying to operate on. That's our segment, The Mindful Investor. We need to wrap this show and go to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is looking at breadth in the form of the stocks above their 50 and 200-day moving averages. And as a reminder, hold on just a second here. I'm looking at the wrong list. There we go. I think one of the biggest problems is we've seen that we're way too focused on the breadth, way too focused on the short term as opposed to the long term. And for me, when I'm looking at breadth, I want to think about the trends in the breadth. And in general, what I'm looking for right now is whether or not we're able to get back above the 50% level. What we've done now is we've gone back below 50%, which means less than half of the S&P 500 are in an uptrend above their 200-day moving averages. If I'm more constructive, I want to make sure that that list is above 50%, and the more that stays above, the better I'm going to feel. Now, when I think about breadth, chart number 2 is looking at the summation index, the McClellan summation index. This is a different way of thinking about breadth. What Tom McClellan's parents, Sherman McClellan and his wife, created an indicator called the McClellan oscillator. The McClellan summation index is a derivation of that. It basically uses that over time and accumulates those values. In general, if this is above 0, if it's in an uptrend, that means that the breadth overall is constructive. When it rotates lower, when it's in a downtrend, that means that it's more negative, that the breadth is more negative. This has gone above 0 and has remained in an uptrend, suggesting that the trend has continued positive. I'm looking at that, and this lines up a little more with the cumulative advanced decline lines that we've talked about on the show. It's just a different way of sort of breaking down that sort of breadth. So here we have sort of a mixed read from breadth, which is the reason why I'm showing those two back to back, is because it's sort of how the market feels right now. You have some indications suggesting sort of long and strong, things are constructive. You have some other things suggesting more that the breadth is leaning more, a little more negative. And I think making sense of the two of those is going to be really key. Finally, though, I think the chart of technology is the third one that I'm going to incorporate into the 3 and 3 today. The outperformance of tech continues up today or flat today, while the rest of the market is sort of questionable. I certainly see this as a form of offense, because there are groups like semiconductors that are doing very, very well as leadership, but it's also serving as defense. So when people are getting nervous, I think they're going to continue to rotate more toward the X. Okay, so regardless of whether you're long-term bullish or bearish, something like technology could be an interesting place to park. That's our show for today, folks. The Final Bar. I want to thank my guest, Jay Petit, joining us from Singapore this afternoon. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.